Hello everybody, welcome. Today I'm going to walk you through margin accounts and the implications they have for Canadian investors. When we think about margin, a lot of times people get confused what we're referring to as margin. Simply here, what we're talking about margin is we're going to use leverage. Okay, so we're going to use the leverage, or we're going to borrow money, right? We're going to borrow money from our dealer, broker, or someone else to buy securities, and we can also need a margin account to short securities. So we're going to walk through a couple different examples, those implications for Canadian investors, and really what investors need to know in terms of how much margin they need to put up for a purchase they're going to long or buy, and how much minimum account balance is for an individual who's going to short a security. And we'll walk through some different examples of what shorting is. So the first slide here really shows you margin trading. So from the first slide, I just told you that a margin account simply means you're going to borrow a portion of money to invest in some sort of security. And most of the times when we see this is usually referring to equities or stocks, right? So you may want to borrow some cash to buy shares of Barrick Gold or Bell Canada or Rogers. And really we're trying to use the leverage here to amplify potential positive returns you may see if you're in a long position. So here, this is really going to show you the effects that leverage has in terms of buying securities. In simple, we know that if we borrow money to invest in the return that we would see exceeds that of the potential interest we're paying on that loan, we're going to have some amplification of returns. And that's simply what we refer to as leverage. Now, leverage can be great in upward markets, but it can also be very detrimental in downward markets. And so, again, margin accounts also refer to short selling. Okay, so many people are probably familiar with this term, shorting a security. This simply means you're going to take the opposite position as a long when you're foreseeing the future price trends in an asset. So if I short a security, that just simply means I hope that the price is going to fall. Okay, so buying on a margin, this simply means you're going to be long a security. Short selling on margins simply means you're going to be shorting that security. Now, key thing to remember here in Canada and in the US, not all firms allow margin accounts, right? And the reason here, guys, is that not all firms allow margin accounts because these type of accounts are very risky. Okay, so lots of people lose a lot of money in their margin accounts. You need to have some sort of a sophistication, some sort of awareness of the threats and the risks that are associated with either going long on margin or shorting a security on margin. There's lots of things that investors need to be aware of, and thus many investors will not meet the thresholds that broker dealers may have to open margin accounts. So very risky. Not all firms will allow those. And the next thing is the interest, right? The interest on a loan is calculated daily, but is going to be charged to you on a monthly basis. So these guys are going to be lending you, right? So in this case, they're going to be lending you cash here in the long position. They're not going to do this for free, right? The broker dealer, the firm that's lending this cash to buy securities, they're going to want to get paid for lending this money out, and they're going to charge this on a daily occurrence, but won't be charged to you until the month end usually. Again, in the short here, remember, in the short here, you are borrowing shares or securities. Okay, so if we walk through, instead of borrowing cash, you're borrowing shares. Okay, so if we walk through this, what are you going to do in a short sale? You're going to borrow some shares, and then the next step is you're going to sell these shares into the market immediately. Okay, so you're going to sell these shares into the market immediately, and then eventually you're going to have to buy these shares back. So this would be one, you're going to borrow. Two, you're going to sell these shares into the market immediately. Three, at some point in time, you're going to have to buy these shares or the security back at some point in time. And 4, then you're going to return to the original holder. Okay, so there's 4 steps here. Now, obviously, if we walk through these 4 steps, if I borrow these shares and these shares were worth $50 here, I sell these shares immediately back into the market, let's say at that $50. Okay, at some point in time, I'm going to have to return these shares to the original holder. I'm hoping that the share price is going to fall. So when I go back, and let's say if the share price did fall, I'm hoping it's going to fall. Let's say I go back and I buy these shares for $40 in the market. All of a sudden I would have made a $10 profit, right? So the difference between what I'm buying these shares for here and what I originally borrowed these shares at and sold them into the market, it would be a $10 gain. So that's shorting, right? I'm going to benefit from a downturn in the price. Now, there's some other specifics that are involved with short selling in terms of what happens with a dividend. If I borrow shares from a dividend-paying stock and it pays dividend while I have these shares borrowed, there's some complications to that, along with some other complications. But quickly, we'll just deal with the dividend one, is that if that happens, the person who is borrowing these shares are obligated to pay the borrower, right? The person who lent those shares that dividend. Okay, so there's some complications that surround shorting. This is the very simplistic version of what that has. And also, in order to short sales, you have to find a borrower. Right? We have a lot of shares out there in the Canadian market and in the U.S. market where there's really not a whole bunch of short positions available because people aren't willing to take that risk by lending these securities out. And there's other, provisions in terms of, short selling, in terms of trading. The requirements and regulations surrounding that has been beefed up a little bit in financial crisis situations we've seen, not only in the U.S. but also in Europe. Some additional regulations and scrutiny surrounding shorting. Okay, but let's move on, and we're going to kind of look at some different calculations, kind of a walkthrough of an example of a long position. So in this example here, we have a long margin example. So the investor is going to buy 1,000 shares of ABC on margin. Okay, and currently right now, the shares of ABC are selling for $7.50 per share. And here, this security is eligible for a 70% margin loan. Now, this is going to change depending on the security and a lot of times depending on the price of the security. Commonly, we see broker-dealers set different limits in terms of how much the margin loan will be available for a specific security. There's a list of securities eligible for reduced margin, securities eligible, and these securities are usually safe, very low volatile assets. In Canada, IIROC publishes usually about a quarterly report in terms of what type of securities are eligible for reduced margin, but not all securities are going to be eligible for this margin amount, and this is going to change for each broker dealer. So this is just an example here. Okay, a lot of times if this price here, this $7.50 price, if it was very low, let's say $1, the margin loan, right, the broker dealer willing to provide you this loan would be much less. But in this case, we're just going to use the $7.50 price example, and in our case, we're just going to assume that the maximum margin loan willing to be provided to us is 70%. So, what would happen here? What would the loan be? How much capital would I have to put up as an investor? We have to go through a couple different calculations. So the first one here, we could just put the purchase price of this transaction. This is easy, right? So this is just going to be 1,000 shares multiplied by the price, which right now is $7.50. So this is going to come out to be $7,500 of the purchase price that I'm going to put up. The margin loan, right? The margin loan which my broker dealer is willing to give me. This is another easy example. Well, if the purchase price is $7,500 and we've just said that the eligible margin loan is 70%, we can multiply this by 0.70, and this is going to give us a loan to purchase this asset for just over $5,000, $5,250. So we have this loan of just over $5,000, but a purchase price $7,500, which means that the required capital that I have to put up, my own capital, so this is my own money that I must put up, is going to be equal to $750. Hello everybody, I'm back. So I got a quick call there. So this is going to be $7,500 minus this $5,250, right? The loan that I was given here. So then the required capital that I must put up is going to be just about $2,250. Okay, so that's the required capital that I must put up for this transaction. Now, I put this capital up. I own these shares. Now, this was the initial margin that I had to put up. This was the initial loan that I've gotten. Now, we all know in asset pricing worlds that this price here, this $750 price, isn't going to stay $750 forever, right? This price is going to change, and you're going to change on a daily basis. So what happens if the price begins to change? Well, a couple different things. If the price goes up, this is good for me, because at the end of the day, if the price begins to rise, this margin loan here, right, that I've been given for $5,250, this margin loan is actually going to rise, because now all of a sudden the collateral that I have behind this loan has risen in value. So they're going to actually give me a higher loan amount if $750, let's say, goes up to $1050, right? This is good for me. And hence, I'm going to have less required capital that I have to put up. But let's do the example down here that I have. If the price goes the other way, remember, we're in a long position. We're hoping that this asset actually goes up in value. But what happens if the price goes down in value? This is where we're going to get a famous margin call, and this is where the margin call comes in. So if we go through this example, the margin loan, let's say if the price per share goes down to 5, the margin loan that my broker dealer is now willing to lend me, so the margin loan is going to be based on now this $5 per share amount times 1,000 shares. So now all of a sudden this is going to equal 5,000, right? That's really my collateral that I have. That's the value of the collateral that I have now, multiplied by, again, this is not going to change in our example here. The margin loan amount, this is going to be 70%, so I can times this by 0.70, and this is going to give me a new margin loan today that's worth $3,500. So it's good. I still have a decent margin loan, but you can see that my original loan was $5,250. Now the broker dealer is only willing to lend me $3,500. So now the next question is, well, what is the required capital that I must put up in this account now? Before it was $2,250. Now all of a sudden the required capital is going to equal the original capital amount, the $7,500 minus the $3,500 revised broker loan, right? So this would be the revised broker loan down here. So now all of a sudden the required capital that I must put in is equal to $4,000. Okay, not everything's bad here right now, because I've already put in $2,250 in the required capital from my previous day. So the initial margin I had put in is $2,250. So now the margin call that I'm going to require to meet is going to be in the amount of this $4,000, right? This new required capital amount that I must have minus the original capital I put in. Excuse me. So this is going to equal $1,750. 1750.00. This is now going to be my new required capital that I must meet, and that's my margin call. So this is the total amount this is the total amount that I must put in, this $4,000. I've already put in $2,250, which means I'm going to get a margin call for $1,750. If I don't place this $1,750 in my account, usually by the end of the day or by the end of the next business day, my broker dealer who I have this margin account with is probably going to close out my position. So they're going to close out my position, sell these shares at $5 per share, pay off the loan that they have provided me, and then essentially they're going to lock in my 50% price loss here in terms of this share dropping from $7.50 to $5. So that's an example of a long margin example with a margin account. Let's go to the next slide and let's look at a short selling example. So the short selling example is going to be kind of similar to what we saw in the long margin example, but here in this case we're not going to have a loan per se. We're going to have to meet this minimum credit balance. Remember, the loan here is coming from borrowing the security. So I'm going to borrow the security, right? Remember, then I'm going to sell this immediately in the market. I'm going to receive this cash. This is going to go into my credit balance within my broker-dealer account. And then I'm also going to put additional capital into this credit balance to ensure that I'm going to have enough capital to buy back XYZ company in case the price goes up. Because here, remember, we're hoping the price goes down. Okay, so let's walk through quick examples here of XYZ company. An investor is going to short 500 shares of XYZ, and the current market price is $15. So how much must the investor put up as a margin if in this case here, the minimum credit balance that the investor must have surrounding this asset is 130% minimum credit balance. And again, just like in the previous example, this may change depending on your broker dealer. This is an example. Okay, so some securities are eligible for reduced margin, some securities won't meet those thresholds. So this 130% is just an example right now. This can change with different broker dealers and with different securities. So the minimum, so here the required minimum account balance is going to equal, okay, so the required minimum account balance is going to equal these 500 shares times by $15 per share, okay, and then that's going to be multiplied by 130%, okay, or 1.30. This is going to give us a minimum account balance required of $9,750.00. So that's our minimum account balance required that we must have. Now the good thing is that we're going to get a big portion of this minimum account balance required by selling these 500 shares at $15. So the proceeds that we're going to receive from selling these shares, right? Remember, we borrowed these shares. We're going to take these shares and then we're going to sell these directly into the market. The proceeds from the short sale that we're going to receive from that is going to equal $7,500, right? So this is going to equal 500 times $15 a share. Okay, the proceeds from the short sale are going to equal 7,500. So we're going to take that 7,500 and what are we going to do? Well, we're going to put it in our minimum account balance. So now the required money or capital we must put in to our account is going to equal now this minimum account balance requirement. So that's going to be $9,750 minus the proceeds that we've sold those securities for minus $7,500. This is going to equal $2,250. This is going to be the amount of money that we must put in to our credit balance on top of what we've sold those securities for. So $2,250. So that is the additional margin that we'll have to put into our account here. Now again, in our case here, we're hoping that the price drops, right? The price drops. That's really what we're hoping for in a short sale position. Again, the price may not drop. It may go up. It may go down. let's do an example here. If XYZ's price, okay, declines to $12, what's going to happen, to the investor? Well, we know this is a good thing in the short sale. We know that we're going to have some sort of positive from this because we're on the short position. So in this case here, we would say, well, what's the new required minimum account balance? Okay, so the new required minimum account balance. So here we would take 500 shares. Now we would multiply not by 15. Now we're going to multiply by $12. And then we're going to multiply this by 130%. This is, again, not going to change in our example. Now the minimum account balance required is $7,800. Okay, that's good. We know from the previous example, this is not going to change, right? This is not going to change. The proceeds from the short sale is not going to change. So these proceeds from short sale is going to remain. We sold this at the initiation. This has been sold. This is never going to change. This is $7,500. Well, now all of a sudden, if we've already have $7,500 in our account from the proceeds, the minimum account balance now, if the price has dropped to 12, now all of a sudden, the required capital that I must put in is only now $300, right? So this is the required capital that I have to put in on top of the short sale proceeds that I've obtained. Well, hey guys, look, from the previous example up here, I've already put in $2,250. So I already meet the minimum credit balance required. So here, if I've already put in $2,250 and now all of a sudden I only need $300 in, I can take off this $300 here. This is going to give me an excess, right? So this is excess capital that I have in my margin account. What can I do with this excess capital? I can do a lot of things with it. I can leave this excess capital in the minimum account balance, and I can leave it there in my credit balance because potentially this price may go up, right? If this price goes up to 13 the next day, right, there's going to be a new minimum account balance requirement. Potentially I may have to put in more capital. So I may just leave that there to kind of give me a buffer against margin calls that I may receive. But I could take this $1,950, I could take it out, and I could either go use it as cash. This is my money. I could take it out, go take the money out, use this to, buy things, do what I want with it. Or I could take this $1,950 and make new transactions within my account, whether that's, more short selling, whether that's taking a long position in a different asset, lots of different things I can do with that. But those are two examples of a margin account in terms of a short sale example. And remember, this can go the other way around, right? So instead of 12, this can go what? Up to 20, okay? And now your minimum account balance is going to now be changed, okay? But this is never going to change here, right? The proceeds from a short sale are never going to change. But you can walk through this example. It's very important to walk through this example and kind of see the different components of margin accounts. And that's a short sale example. Here again is the long margin example. Same thing here, guys. In our example here, we assume that this price went down. So this was a bad thing for us in this case. But this, for example, could go the other way around. Instead of this price going to 5, this price could go to 15. And then all of a sudden, the margin loan that's going to be given to us is now obviously going to be much higher, okay? And then we're not going to get a margin call. We're going to have excess margin in our account. And we could take that out example. So this was an example of margin accounts in Canada. Remember, margin accounts are simply what? Just looking at an account using leverage, whether you're borrowing money or borrowing securities, whether you're long or short there. So I hope that helps, guys, in kind of understanding margin accounts. If you like the video, make sure you give it a thumbs up. And you can always subscribe to follow new updates I have.